Well, hello, everyone. Chad Franzen. Welcome to the Kingdom Finance Show. I'm so glad you're here. Hey, on today's show, we're going to talk about the economy and what's going on with interest rates. It was not that long ago when it was widely expected that there would be several interest rate cuts in the United States in 2024. But on today's program, I'm going to dig into some of the data and the economic reports that have come out for the month of April and early May 2024 and tell you why that is most likely not the case, that we're going to see a lot of interest rates in cuts in 2024. Hey, before we get started on the show, thank you again for being a part of the Kingdom Finance Show. I want to encourage you to subscribe and like it. And really the goal here on the program is to provide you insights, teaching on how to bring clarity out of chaos when it comes to what's going on in the markets, the economies, and the world of personal finance. So all of that around a framework that is what I call a biblical worldview. So actually taking what the Bible teaches, taking what Jesus taught and applying it to us as business owners, investors, entrepreneurs, leaders of our family, leaders in our community, and making choices with our finances that do not violate biblical values. So let's get started. I'm really glad you're here on today's show. Now, one of the things at the end of last year, 2023, the beginning of 2024, it was widely predicted by all the economic experts that we would see 4 to 5 interest rate cuts in calendar year 2024. Now, again, we're talking about the U.S. Central Bank. It's led by Chairman Jerome Powell and a board of governors. They create the monetary policy for the United States. Now, each country has their own central bank, right? Japan, UK, and so forth. But a lot of the leading countries are looking at what the United States Central Bank is doing. And so what we've all been through coming out of COVID was a lot of interest rate increases, right? You know that if you've been involved in buying a home or investing in fixed income, or if you've been in any way involved in the financial side of a business, a ministry, or just your own personal finances. Now, what has happened, though, is the job market, and I want to try to summarize this on today's show for you, is the job market has remained very hot, very strong through 2023 and into the first quarter and into April of 2024. And one particular inflation reading that came out. Now, remember, we've been talking about inflation for some time. I've been telling you that I did not think inflation was going away. And in fact, is over a year ago, I was teaching that we really felt like we would see a double dip inflation, much like we saw back post World War II, much like what we saw in the 1970s during the oil embargo and Iran crisis and all that hostage crisis. So again, inflation is not going to spike back up to where it was. We saw peak inflation when it was north of 8%. However, it is very stubborn. And so it has spiked back up. What the Federal Reserve wants to do is get inflation down to, around 2%, right? And so that's what they deem as is kind of their target on that. Now, why is this important to you? It's important to you whether you are a stay-at-home mom, a retiree, a teacher, whether you are a entrepreneur, whether you're a starting out investor or a multimillionaire, doesn't matter where you are. Why it's important is that the supply of money dictates how well we can make an impact with our financial resources. So I was sharing with a friend recently this concept, which I'm not going to teach on today, but this concept of having the ability to do transactional money. So able to do commerce, to do business where you're doing transactions, right? Which many of us are. So transactional money. But then there's also this concept of transformational money. So transformational money in the Christian world is going to be through your churches, through your parachurch organizations, mission organizations, teaching ministries that you support, Bible colleges, and so forth, right? But the mindset here is if we can have transactional ability in our finances, but have a transformational mindset, on what we do with those resources. That's really the secret sauce to becoming a kingdom impact investor. Okay. So just kind of want to frame that here because I'm going to dive into some of this technical information. I don't want you to get lost in that. We're just trying to gain clarity. We're trying to kind of understand the seasons and the times of where we are. We're not necessarily trusting what the media is going to tell us on that. Okay. So the personal consumption expenditures price index. Big term, what you need to know is that's called the PCE index. And what it captures is inflation across a wide range of consumer expenses, like what you and I spend for goods and services. What it does not include, okay, is it does not include food. It does not include energy. Now, we've talked about here on the Kingdom Finance Show how extremely high inflation has been in food and energy, right? So conveniently, this number does not include that, which would be much higher on that. I don't think any of us realize, but groceries, right? Apparently, the government doesn't think groceries have gone up that much or going out to eat at a restaurant. We did a study and found that, $100 bag of cart of groceries that you bought pre-COVID, and this varies a little bit depending on where you live. I'm talking about here in the United States, but that $100 of groceries pre-COVID today in 2024 is probably going to cost you the same items would cost you about $140 to $145. Okay, so about a 40% increase since COVID on a lot of your staple. You're going to Kroger's or Safeway or wherever you shop, right? That's how much they've gone up, and even in some cases, the companies have reduced the size of the contents on this. So inflation's the real deal, right? There are parts of the economy that are already in recession. People often ask me that. But definitely, you look at small business survey, you look at sales in different parts of the industries that comprise the U.S. economy. There are parts of it that are, you can say, are very much declining for 2 consecutive quarters, which would be the definition of a recession. So let me stay on point here for today's show. Again, we're talking about interest rates and what happened to the interest rate cuts, ? Again, at the beginning of this year, it was widely expected that we would see 4, maybe 5 interest rate cuts heading into the November 2024 presidential election, and that Chairman Powell and his group would be what we would call a soft landing on rates. However, I want to share with you today that is not the case. Spoiler alert, rates are not going down as quickly as everyone wants, particularly those in the real estate community, and those that are wanting to, get lower mortgage rates and lower, loan rates for business lending, construction, all those things. They're not going to go down as fast as we think. And the reason is the job market has stayed hot, and this PCE index, which is one of the key inflation index markers that the Federal Reserve looks at in March, okay, that data was higher. It went up. It was higher than expected. Okay, so now we have seen all 3 major factors, what they call the CPI, the PPI, and then this PCE, all these inflation tracking mechanisms that the government follows, that the banks follow, all of them have now rose in value. They've risen for 2 straight months. So what that means is inflation is not going down as much as we want. So I present to you as well, if the job market's hot and these inflation markers are still rising 2 months in a row now, how can the Federal Reserve say that they're going to cut interest rates? This is clearly not the direction we're heading. And in fact, the core PCE annualized change was up to 4.4% for the month of March. Now, the Fed wants it down to 2.5%. We're more closer to 4.5%. Okay. So that's not the direction that you want to be trending with a hot job market and with stubborn, even ticking back up inflation indicators. Now, another thing that we look at is what's going on with the bond market. So we're talking about the economy. We're talking about how to make sense of making money for making a difference, whether you're a real estate investor, whether you're running a budget for a ministry, whether you're just trying to be good with your fixed income as a retiree. We need to also pay attention to what's happening in the bond market. Let's take a look at that. So the 10-year Treasury note, the 10-year bond market, has gone up significantly since the end of the year. Now, on January 1st of 2024, the 10-year bond was at 3.94. Now, sitting here today and this past week, the 10-year bond has been anywhere from 4.6 to 4.7%. So when those bond rates are going up, that is a proxy for what's going to happen in the interest rate world. The bond market's a historically very good leading indicator for the health of the economy, for a potential bear market in stocks. And so this is significantly higher. It got as high as 4.73 here recently. It's come back down to a little under 4.6. But what that's really telling us is interest rate cut is very unlikely. This is what the bond market's saying. So I just presented to you the inflation data. Again, I'm trying to summarize this for you instead of just breaking out a whole bunch of charts. And, we do that in our for our Wealthbuilders investment clients. We do some economic webinars where we'll kind of go through that. But I just want to kind of talk to you here without getting too deep into the charts and all the lines. But the three major inflation indicators are all trending up, which is a negative for rate cuts. The 10-year bond, 10-year U.S. government bond has been trending up since January 1st, which both of those are negative. They're negative indicators when it comes to how soon and how quickly, to what measure will the Federal Reserve lower interest rates. In fact, if you look at things like, mortgage rates, you look at new car auto loans are at really all-time highs. You have to go back as far as 2008, 2009 to where auto loan interest rates were as high as they are. They're, upwards of 7.5% to 8% on that. So again, we're talking about affordability in the economy. And I want to just share a couple other things from my notes here, but this is a big deal because as auto loan, car rates stay high, mortgage rates stay high in that 7.5, 7.75, even 8% range. It creates a major damper on consumer spending and on the ability of interest rates to not come down to help people afford things more so. All right, so let me kind of jump ahead and kind of tie some things together here. One of the things on the market when you look at the rates staying higher is what this means to me, and this is my personal opinion. I'm not giving you professional financial advice here on the Kingdom Finance Show, but what this tells me is we're in a high rate environment. We're in a high inflation environment, right? It's not as high as it once was, right? Praise God. But it's 4.5%. It's not trending down towards where Chairman Powell wants it to just yet. And then we have an economy that's still growing, right? There's still a hot jobs market, but it's not growing super fast, but it's also not contracting. So let me explain a term to you. So what they call that in economics is when you have higher inflation, rising inflation, and you have just a slowly growing economy. It's not growing lights out. It's not contracting, to be clear. That is what you call stagflation. So we've talked about inflation. Stagflation is you still have elevated interest rates and inflation, but the economy is just bumping along. It's growing a little bit, but it's not growing at 3 to 5% per year. It's also not contracting at a negative rate per year. That's what we call stagflation. So as you're thinking about how to be a good steward with your resources, how to invest, how to create budgets for your family, your business, your ministry, we need to be aware of what a stagflation environment is. Okay. So oftentimes, again, my personal opinions, observations I have made over the last 20 plus years is when you're in a stagflation environment, commodities, real assets, tangible assets tend to hold up better, right? I'm not giving you advice. I'm just saying at a high level, those type of things seem to do better. Historically, the US dollar will do stronger compared to the euro or the yen or other global currencies when you're in this stagflation environment. Now, when we think about investing, there's still a lot of good opportunities to invest in. The key is just to know kind of what's going on with interest rates, what's going on with Fed policy, government policy, so you can sit down and craft a personalized plan for how to invest, how to budget, and how to save. Now, when I talk about investing, I always talk about there's two at a high level. I'm teaching here. You can think strategically, where you're looking kind of 3 years out or longer on strategic goals, saving for college, saving for retirement, wanting to just build generational wealth long term, right? How to grow your business or your ministry. You're kind of thinking strategically. The second level is what we call tactical. So having a tactical plan is taking these type of data points that I've talked about here on today's show and determining, well, I still have my strategic goals in things we're implementing, but tactically over the next 1 to 18 months, what do I need to be doing? How do I need to be positioning my personal resources, my company's resources, the ministries that I work with, their resources? What do we need to be budgeting for? Where should we be spending versus saving, right? Should we be in a more asset preservation versus asset accumulation phase? Again, these are all things that kind of go into that, which can be a little bit overwhelming. So one of the things as we think about, hey guys, interest rates are not going to go down that fast. I'm going to close with kind of my thoughts on what I personally believe, how this is going to play out. But when you think about, hey, how do I create a plan for when interest rates do go down, a financial plan that has both strategic and tactical components to it, I want to encourage you to reach out to our team at Wealthbuilders Investments. So we have a team there, myself included. We'll be happy to visit with you. And in fact, we're offering right now just a complimentary phone consultation. So if you want to connect with us and just find out, hey, I want to personally apply this to where I am and see what decisions I need to be making now going into the summer and going into the election this fall to protect your money, but also to make good investment and financial planning choices. So in order to do that, again, that's a complimentary phone consultation. You can reach out to our team at wealthbuilders.net/invest. So wealthbuilders.net/invest. If you're a current client, you know how to reach us. I'd be happy just to set up a call with you. But if you're not familiar with the Wealth Builders Investments team, that's the best way to get a hold of us. And we do have just a few slots that we make available each week for people that we're not already working with to provide that consultation. So check that out. I really want to get that in your hands if you can, if you feel that's appropriate for where you are. All right, let me kind of finish up here on today's show. When we think about stagflation, we're thinking about real assets. So real assets, tangible assets, commodities, materials, currencies, things like that. Those historically, just from a teaching perspective, they do hold up better during these environments. Now, let me speak a little bit about real estate. With mortgage rates likely higher for longer, because interest rates are going to stay higher for longer, I do think what we are already starting to see, and I know some of my friends that are real estate professionals are sharing with me, we're seeing inventory levels of single family homes. We're seeing those start to increase. More homes coming on the market than we saw seasonally last spring. And again, real estate's local. So what's in Ohio is different than Arizona, than Texas, and all that. So you really have to understand your local market with real estate, whether you're looking to buy personally for your family or as an investment. But again, we're starting to see inventory kick up because rates are staying higher. And we're also starting to see inventory stay on the market, days on the market longer for that. Sellers are still somewhat delusional on what their asking price is, although there is always migration with people moving for jobs, for school, for family. And so there's always going to be real estate that is it's open for negotiation because people need to move. They need to get to the other side of the coast, and they're not going to negotiate over hey, I want to get $100,000 more for my house. They need to move. So there are opportunities in there. Now, one of the key things I'm seeing just from a financial planner is there is an affordability issue. Okay. I already talked about interest rates on loans for cars. The 30-year mortgage for real estate is still very elevated. So a lot of this has to do with, it's an inventory issue for real estate, just how many houses are on the market to look at if you're an investor or just for your personal primary home, but it's also an affordability issue. And so part of the pickle, if you will, that the Federal Reserve has gotten itself into is because they've had to raise rates so much as real estate prices and asset prices were going up high, kind of creating a bubble in some areas. It's created kind of this perfect storm of where you still have higher asset prices and you still have relatively higher interest rates. Now, those of you who were investing in the 1980s, early 80s, mid 80s, can tell stories of interest rates much higher for mortgages, 10, 12, 14% for a mortgage. Historically speaking, mortgage rates, probably the equilibrium should be somewhere around 5 to 5.5%. So they're still elevated. They're certainly much higher than, when we were buying real estate at, 3% range for mortgages. So that being said, you've got this dual thing where rates are still high and the asset prices on the real estate is still high. Now, real estate's local. You can always find a deal. It's not like buying stocks or bonds where the price is what the price is that day. But it really is an inventory issue that is coupled with an affordability issue for a lot of the younger generation wanting to buy their first home, as well as for retirees and boomers who maybe are wanting to downsize. They have equity in their home, but then what are they going to buy next if they sell? So let me kind of summarize this. I know I've kind of thrown out a lot of thoughts. I think, when we look at the markets, we look at how they're responding to interest rates, I do think we will probably get a rate cut this year. There's right now, the bond market is predicting a 30 to 40% chance that we will see an interest rate cut in September, which is the meeting before, I don't believe there's a meeting before the November presidential election. So there's about a 40% chance as of this past week, based on the bond market. Again, that changes every day, that we'll see an interest rate cut in September. But again, Federal Chairman Powell has come out and he said he's committed to keeping rates higher for longer. Now, this was so serious that even the Fed chairman had to answer the question of, Fed Chairman Powell, would you consider raising interest rates? Okay, we've been talking about interest rate cuts for months, right? This is how strong the economy is. This is how stubborn inflation is that there's even the question being floated out there as well, is it possible that the Fed would actually have to raise interest rates again? And I don't think any of us thought, at the end of last year, that would even be on the table to talk about as we're here in April, the months of April and May, heading into the summer of 2024 on that. Now, Chairman Powell did come out and say just this past week, they are not planning to raise interest rates. And so I think that's off the table. I do think what I want you to be prepared for is rates are going to stay higher longer. I do expect a rate cut in September. I think particularly going into the presidential election. I think although there's not supposed to be a political bias on that, I would expect a rate cut then. But I don't expect rate cuts to come successively, like one after the other. I think we may see one, maybe two rate cuts this year, but definitely not more than that. So, and who knows, we might only see one rate cut for this year in 2024. So I will keep you posted. Again, this is a fluid deal. The Federal Reserve meets most months and they come out with their comments. But again, in summary, the job market is still strong. Inflation is still stubborn. You and I know that because of what we're spending at the grocery store and at restaurants, right, for our consumer goods on that. These data points have to get softer. They have to get weaker in order for interest rates to be cut at the federal level. That's really the bottom line on that. So in summary, I really want to encourage you, keep tracking with us at the Kingdom Finance Show. We'll do another episode on this probably next month. We'll have some more data. We'll kind of cover what's happened in the month of May for that. But until then, I want to encourage you, stay focused on applying biblical values to how you're running your companies, how you're investing for the future, and how you're looking to give to expand the gospel, because that is really the key. We want to take this information. I know some of it's boring to sift through, but we want to be wise. I do want to encourage you. There are always opportunities when you're looking at financial planning and investing. Again, this show is not designed to give personal advice. I'm trying to educate and teach you on topics that are out there that are going to be important for that. So again, I want to thank each of you for being committed to becoming, as I'm attempting to become, kingdom impact investors. In an upcoming show, I'm going to talk more about that, of how we need to answer the call to be kingdom impact investors and what that means. We really have to follow what the Bible's saying as far as principles and ethics and values, if we are what we say we are as Christians and disciples of Jesus. So that's all I have for today's show. Thanks so much for being a part of it. Again, check out wealthbuilders.net/invest. You can get a free complimentary phone consultation with our team to talk through any of your personal financial planning and investing questions. And what I want to encourage you is, if you don't have a strategic and a tactical plan for how to manage your resources, how to manage your budgets, personally and professionally during these very unique times with interest rates, I want to encourage you to do that. All right. Thanks again for being here on the Kingdom Finance Show, and we'll see you next time.
Thank you so much for joining me today on the Kingdom Finance Show. If you enjoyed this podcast, please subscribe and leave us a review. It really helps to get the word out. For more resources on becoming a kingdom investor and to connect with us directly, visit our website at wealthbuilders.net. That's wealthbuilders.net. We'll see you next time on the Kingdom Finance Show. The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Authentic Counsel, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine risk factors and other information contained in the memorandum.